Sanjay had been in Dubai for 3 years when an email from his Indian bank popped up. Subject: Urgent FEMA compliance notice. He opened it casually and then froze. The bank was warning that his old savings account could be frozen and that there might be penalties under India's foreign exchange rules. From his point of view, he hadn't done anything wrong. His salary came into his Dubai account. Once in a while, he'd send money to India into the same savings account he'd used since college. His parents withdrew cash from it, a few SIPs ran from it. Life felt normal. The problem? Sanjay had become an NRI. His account was still a resident savings account. That's mistake number one many NRIs make, continuing to use a normal resident account after shifting abroad. Welcome to NRI Shala. I'm Malvika, and this is where we navigate NRI life together, from visa guidance and investments to maintaining your roots while building your future abroad. Let's deep dive into Sanjay's story now. Under India's FEMA, once you become a non-resident, you are not allowed to operate a resident savings account. That account has to be converted to an NRO account or closed. If you keep using it, technically every transaction is a compliance issue. Banks are now much stricter about this. Their systems regularly scan for customers with foreign addresses or overseas numbers still tagged as resident. In Sanjay's case, that's exactly how his account got flagged and why that warning email landed in his inbox. The risks are not theoretical. You can face an account freeze, long back and forth with the bank, and in serious cases, heavy FEMA penalties. All because nobody clearly said, once you become NRI, this old savings account has to change. So let's reverse engineer what Sanjay should have done. The ideal sequence is simple. Inform the bank as soon as you know you're moving abroad long term. Ask them to convert your resident savings account into an NRO account instead of leaving it as is. Most banks do give you a grace period of around 30 to 90 days after your residential status changes to update your account type, but that does not remove your responsibility. If you ignore it beyond that window, every transaction in that resident account is technically a FEMA issue. Open an NRI account for your foreign salary and, if needed, add FCNR deposits on top of that. In most banks, FCNR is a linked product. You usually need an NRI account before you can open FCNR deposits. Here's the quick checklist Sanjay wishes he'd handled on day one. Notify every Indian bank of your NRI status change right away. If you are a professional heading abroad or a student moving for studies, proactively open an NRO account before your NRI status officially kicks in. Convert or close all resident savings accounts. Set up your NRI or NRO accounts before you start sending serious money from abroad. Sanjay eventually regularized everything, but this first mistake cost him weeks of stress. The good news? The digital era of banking is coming soon with NRI NRO accounts from Aspora, designed to make this entire setup seamless from day one. If you are an NRI or planning to become one, join the waitlist now at the link below and skip the stress Sanjay went through. But back to Sanjay's journey. His next move, trying to send a large lump sum out of India, created an even bigger headache. That's the second mistake we'll break down next. Sanjay fixed his first mistake, so he finally felt sorted with his NRI and NRO setup. And because the accounts were now compliant, he assumed the hard part was over. A few months later, he sold his Mumbai flat for about 2 crore rupees. The plan was simple in his head. The money is in my NRO account, so I'll just send the whole thing to Dubai in one shot. Therefore, when he walked into the bank and said, "I want to remit this entire amount abroad," he was shocked by the answer. The manager calmly said, "So, from an NRO account, you can only repatriate up to $1 million per financial year after taxes and paperwork. We also need Form 15CA and 15CB before we process anything." Suddenly, Sanjay realized there was a second trap here. Just because the money is legally yours doesn't mean you can move any amount out of India whenever you like. So what is actually going on? RBI and FEMA rules separate what sits in his NRO account into two buckets. Current income, things like rent, interest, dividends, pension; principal or capital, like the sale of proceeds of property, inheritance, large deposits of past savings. Current income can be sent abroad freely once tax is paid and documented. Principal, however, is where the 1 million USD per financial year limit kicks in. Sanjay's 2 crore rupees sale proceeds were treated as principal, so he could only remit a portion this financial year up to 1 million US dollars. The rest would have to wait for the next financial year, or he'd need to apply to RBI for special permission with additional proofs. Current income like rent, interest, and dividends can be sent abroad freely once tax is paid and documented. But the bank wouldn't press a button and send money just because he asked. They needed evidence that taxes had been paid correctly first. So Sanjay now had to work with the CA to compute tax on the sale and get Form 15CB certified. He uploaded Form 15CA on the income tax portal, declaring the nature of the remittance. Shared the form, sale deed, and tax challans with the bank before they even initiated the transfer. Only after this trail was complete could the bank remit funds to his overseas account. In hindsight, Sanjay realized he should have approached this very differently. If he had understood the 1 million US dollar cap and the principal versus current income difference earlier, he could have planned the sale timing and remittances over 2 financial years. Separated regular rental income, which is fully repatriable once taxed, from the big lump sum capital amount. Lined up a CA and the 15CA or CB documentation before the sale proceeds hit his NRO account, so there was no last-minute scramble. So the second big lesson is this: don't treat your NRO balance as a free-flow wallet to the outside world. Treat it as a regulated pool where principal has limits and every big outward transfer needs a tax story attached to it. Sanjay now had his accounts corrected and his repatriation plan under control. Therefore, he thought he was finally in the clear. But as the balances in his NRE and NRO accounts grew, another category of problems started creeping in. Not from the law this time, but from the outside world. Fraudsters, swim swaps, phishing links, and dormant account risks. That becomes his third big mistake, which we'll unpack in the next act. By now, Sanjay felt sorted. His accounts were NRI compliant, his repatriation plan matched the rules, so he stopped worrying about his banking. Therefore, when his Indian SIM suddenly went dead one evening in Dubai, he ignored it. Network issue, he thought. He'd fix it later. A few hours later, his email started buzzing. New device logged into your net banking. High-value transaction alert. By the time he checked, several lakhs had already left his account. Someone had done a SIM swap in India, convinced the telecom department that they were Sanjay, got a duplicate SIM, and took control of his number. The moment that new SIM was activated, every OTP for his banking and UPI started landing on the fraudster's phone, not his. That's mistake number 3, treating SMS OTPs and your phone number as if they're automatically safe. The scary part is, Sanjay had made this easier without realizing it. He'd clicked a couple of update KYC links from random emails, reused old passwords, and logged into net banking on public Wi-Fi at airports. None of these felt dangerous at the moment, yet together they opened the door. So what should his security playbook have looked like? Turn on multi-factor authentication that doesn't depend only on SMS. Set alerts for every login and high-value transaction and react quickly if something looks off. Never click banking links from SMS or emails. Always type the address yourself. Use strong, unique passwords for banking and never share OTPs, even with customer care. There's one more quiet risk: dormant accounts. Because Sanjay had multiple accounts and small balances lying around, some of them barely saw activity. After 24 months of no transactions, RBI rules require banks to mark them inoperative and transfer balances to the investor's education and protection fund. Getting that money back later is a painful process. Therefore, part of being an NRI with money in India is basic hygiene. Log into every account at least a couple of times a year. Complete KYC updates on time, close accounts you don't actually use, and Sanjay eventually recovered part of the money and tightened his security. But this episode taught him something simple. Fixing FEMA and repatriation protects you from rules. Fixing security habits protects you from people. And as his balances grew, there was still one more area where he was quietly leaking money every year: in taxes. In the next act, we look at mistake number 4, paying more taxes than necessary or even paying it twice just because you don't know how to use tax treaties properly. Sanjay felt he'd finally stabilized things. Accounts fixed, money moving within RBI rules, security under control. Therefore, when tax season came in both India and his country of residence, he just paid whatever each system asked without thinking about how they interacted. That led to mistake number 4, paying tax twice on the same Indian income. Take his Mumbai flat. It earned him 10 lakh rupees in rent for the year. In India, after deductions and cess, he paid roughly 3 lakh rupees in taxes. That part made sense. The property is in India, so India gets to tax it. But his country of residence also taxed global income. On that same 10 lakh rupees, his local rate was about 24%, or 2.4 lakh rupees. Because he hadn't set up anything special, he simply paid that as well. So total tax on the 10 lakh rupees, 3 lakh rupees in India, plus 2.4 lakh rupees abroad, 5.4 lakh rupees gone on one income stream. Only later did he learn that India has double taxation avoidance agreements with many countries. These treaties basically say if you've already paid tax on an income in one country, the other country should give you credit for that tax so you don't pay full tax twice. To use that, Sanjay needed a very small amount of extra discipline. Get a tax residency certificate or a TRC from his country of residence each year. Submit Form 10F and declare that he's a tax resident there. While filing his overseas return, claim foreign tax credit for the 3 lakh rupees already paid in India using his Indian tax challans or Form 26AS as proof. If he had done this correctly, his total tax would have been closer to the higher of the two numbers, not the sum. In our example, that means paying around 3 lakh rupees overall, not 5.4 lakh rupees. So the reverse engineered lesson is simple. If you earn in India and also file tax abroad, assume a tax treaty exists and ask your CA about foreign tax credit or DTAA treatment. Keep all Indian tax proofs safely. Never treat the two returns as completely separate worlds. Once Sanjay fixed this, his annual cash outflow dropped immediately, and that extra money could finally go into his long-term NRI wealth plan, which is exactly where the last act of his journey begins. By this point, Sanjay had fixed the big 4 issues. His accounts were structured correctly, his repatriation followed RBI rules, his security was tighter, and he wasn't overpaying tax. So the final question naturally became, now that the leaks are plugged, how does this setup actually help me build wealth as an NRI? Therefore, instead of thinking account by account, Sanjay started thinking in terms of a simple long-term money plan. First, he treated his NRE account as his main growth engine. His foreign salary flowed in here, stayed tax-free in India, and from this pool he funded long-term investments, equity funds, bonds, deposits aligned to goals like retirement, a home upgrade, or kids' education. Next, he saw his NRO account as an India cash flow and compliance hub. All Indian income, rent, dividends, interest landed here. Taxes were handled cleanly, DTAA credits were claimed correctly, and only then did he decide how much to keep in India and how much to repatriate. Third, he used FCNR deposits selectively for capital he didn't want exposed to rupee volatility, especially money he knew he would eventually need abroad. That way, big life goals outside India weren't at the mercy of sudden currency swings. On top of the structure, he set a simple review rhythm. Once a year, checked whether his NRE, NRO, and FCNR balances matched his actual goals. Once a year, confirmed tax and DTAA papers were in place. A quick security and KYC check every few months to make sure nothing had quietly gone dormant or vulnerable. The key mindset shift was this: these accounts were no longer random buckets that money fell into. They were deliberate tools, each with a job. So if you zoom out, Sanjay's mistake-centric journey gives a very clear, reverse-engineered blueprint. If you avoid the mistakes Sanjay made and start from the corrected version of his setup, you're already much closer to what a financially sorted NRI looks like. If this breakdown helped you spot even one mistake you might be making with your NRE or NRO accounts, don't let it stay as good information. Take 10 minutes today to review your own setup: resident accounts, NRE or NRO usage, repatriation process, security, and tax, and fix at least one thing Sanjay got wrong. And if you want more NRI-focused guides like this, subscribe, share this with one NRI friend who needs it, and drop your specific questions in the comments so the next video can tackle your exact situation.